Welcome all to today's webinar together with Datscha that we are hosting for our Swedish and Finnish customers today. And I'm very happy to say that we are hosting this webinar together with our owner, Real Capital Analytics. And we have received a lot of interest from clients and have a high attendance rate, which we're really happy about. And we will see how this goes today with me and Tom, and maybe we will host this for another time as well. The topic today is latest trends within the Nordic property market. And it has been an eventful spring, as we all know, due to the pandemic. And there have been lockdowns in a lot of countries, and this has of course affected the property market. And the second quarter, we saw a large change in investments. And we will hear more about this within this webinar. So my name, for those who haven't met me, is Julia Olsson, and I work as Head of Customer Success at Datscha in Sweden. And I'm very happy to have my British colleague, Tom Leahy, with me today. And he is the Senior Director at RCA, and he leads the European Analytics team, who are based in London. And I will hand over to you shortly, Tom, but I will do a bit of background before we go into the presentation. So as a lot of you know, RCA acquired Datscha in December 2019. And just as Datscha, RCA began in 2000, and they have been a pioneer since then. And they have a reputation of having the most timely and reliable transaction data and providing valuable intelligence on market pricing, capital flows, and investment trends. And this is also what, like all this data, is what enables this webinar that we will host today. And we would really much like to have your questions coming through. So in the menu bar in the toolbox, you can expand that and you have the questionnaire. So please send in questions and we will answer them all in the end. And also for those of you who wants to go back to this presentation, we will send out the recording and the PDF afterwards so you can go through it again. I think that's all, and I'm happy to hand over to you, Tom, and take over the stage.
Great, thank you, Julia. Yes, hello everyone. Thanks for the introduction. So yes, my name's Tom Leahy. I work for Real Capital Analytics in London, and I've got a slideshow of about half an hour, maybe a little bit longer today, to talk you through some of the global trends we're seeing in real estate investment, and then drilling down to putting the Nordic markets in context with what's happening all around the world. I'm going to remove myself from the webcam when I start speaking now, I think, just because it's kind of slightly distracting for me, never mind for you. So I'll turn off my webcam now and we can focus only on the slides I'm going to be showing. So there I go. Okay, so Julia's already given a really good introduction of RCA and what we do. But yes, just to reiterate, we're a New York headquartered company founded in 2000, and we provide data on real estate investment market in over 170 countries. It's all focused on the transactions market, and we've got, as you can see, $30 trillion worth of capital events in our database. That's real estate acquisitions, constructions, and financings, and we've got offices across the world now, from the US, Europe, and Singapore as well, in Asia. So that's the introductions, and as Julia said, we brought Datscha on board in December, and we've been working closely with our new friends and colleagues at Datscha since then. Today's agenda, I'm going to talk to you about what's happening across Europe and put Europe in a global context as well, feeding into our global database of real estate investment data. I'm going to drill into what's happening in the Nordic markets, again, put that in context with what's happening in the rest of Europe in the light of the changes that have happened to the market because of the COVID-19 pandemic, and then the tricky question of where next. And I've got some, I might answer that question with some more questions, but hopefully there'll be pertinent questions and talking points for us, and possibly raise some questions to finish off with. Okay, so to kick off, this first chart shows property investment volumes across Europe. So it's every market we track in Europe. And I've split the data down to individual property sales, portfolio transactions. So that's when, 2+ properties are traded in the same deal. And then an entity deal is what we call a corporate transaction. So that might be a merger in the listed sector or a take private deal. And these volumes are all in euros as well. I know some of you will be used to seeing investment volumes reported in obviously in your local currency in krona, but I think pretty much everything I'm showing you today will be in euros, which is our standard for Europe. So 52 billion spent, which is down 30% year over year in comparison with Q2 of 2019, which is not such a bad outturn really when you think about, Q2 of 2020 was really the teeth of the lockdown. That was when economies really stopped. But actually, we still recorded a significant number of deals taking place. At the moment, Q3 looks slower, and that's that last line on the chart there. You can see that, and we've got around 30 billion of transactions so far in Q3, but I think there's some important points to make there. And number one, it's over the summer months, which are usually slower. And also, we do a lot of our data collection as we get towards the end of the quarter and in the month following that. So we'll be doing a lot of data input into our system in September and October. So I would certainly anticipate that number for Q3, which is at 30 billion, increasing quite substantially in the next 6 weeks. But overall, not such a bad outturn when you look at where investment volumes might have been, and I think that reflects some of the momentum in the market and how much capital there is to spend, on real estate. If you look at the dry powder numbers, the amount of equity that's been raised, there's a lot of money out there in this low rate environment. If we compare Europe with the rest of the world, you can see here we've got the Americas region, EMEA, and Asia Pacific. Now, EMEA is really Europe. There's relatively little total of that attributed to the Middle East and Africa region. And you can see that the EMEA region on a year-to-date basis has held up better in comparison with Asia Pacific, where obviously the virus really started and where we saw the first reaction and the first sets of lockdowns before obviously we saw the viral outbreak spread. And then in the Americas on the other side there, which is obviously mostly the United States, where the market has really slowed very, very sharply since the start of April. And obviously that's linked to the issues in the US economy, in the same way that we've got issues in the global economy, but in the US economy, rocketing unemployment rates, and also I think some of the political issues that are facing the US at the moment, I think have probably played into the very sharp slowdown in the market there as well. So that's the volumes picture. But actually, if we change the metrics, it's the same type of chart, but actually switching to look at investment volumes to look at deal count, it actually tells a slightly different story. And actually, the EMEA region is down on a par with the rest of the world. America's, as I've said, is kind of struggling more than anywhere else. So deal count is down 40% year over year, but in the EMEA region, it's down 33%, Asia Pacific down 31%. So what does that say to us? I think it says that more larger deals have been taking place in Europe than elsewhere, and so that's why we've seen volumes hold up better. So those are typically maybe the more complex transactions, the type of deals that will have been in contract for a while, that will have been in negotiations for a long time. RCA data says it takes around 5 months for a deal to go from being marketed to completing, which is an approximate figure. But if you think about that, that would mean that a lot of the deals that completed between April and June of this year were, already being marketed at the end of last year, the start of this year, before the COVID outbreak happened. So the big deals have been more likely to complete across Europe, and you can see this chart here demonstrates that hopefully quite clearly. So I've divided the European market up into lot sizes. So you've got the 5 to 50 million deal bracket, 50 to 100, etc., etc. And you can see there's been a very sharp slowdown in the smaller deals, and that we think though that's a good indicator for the health of the market as a whole. A couple of very large transactions. We saw some very big deals in the listed sector in Germany in Q2. There's a very big deal for some UK student housing also in Q2, some big shopping center deals in Spain and France also in Q2. So those deals have masked maybe the underlying slowdown in the market. So yes, those deals have continued to complete, but actually the smaller transactions have really slowed very sharply. And on a relative it's on an absolute and a relative basis. So in percentage terms as well, the rate of the slowdown in smaller deals has been much sharper. So what about the sector story? And you can see hopefully clearly here, this is kind of, I call this a three-dimensional look at the sector story across Europe. So you've got the size of the bubble is how much was invested in Q2, and then along the horizontal axis, you've got the change in deal count, and along the vertical axis, you've got the change in deal volume. So actually apartments looks pretty good. Deal count is down slightly, deal volume's really on a par with Q2 of last year, and it's by far the most invested in part of the market. And that possibly is, there's lots of structural reasons why more money has been going into the apartment sector. You'll have seen that across the Nordic region in Sweden especially, but also in Denmark, and I guess to a lesser extent in Finland and Norway, but also across Europe in the UK and Germany and France and Spain. We've seen a lot of capital in the Netherlands, a lot of money going into the apartment sector, and that's really a diversification by investors away from some of the core commercial parts of the market. Then down at the bottom, you've got the hotel sector, which has really been very badly hit in terms of investor sentiment. Not surprising with the restrictions on travel causing all sorts of problems for hotel operators. I heard this morning that Whitbread, who own the Premier Inn group of hotels, are going to lay off 6,000 staff here in the UK. I know it's a UK story, but I think it's emblematic of the problems that are affecting hotel owners and operators at the moment, and that's a part of the market that's really struggling. And then elsewhere, you've got some other interesting little stories. Obviously, logistics has continued to be very much on everyone's radar, and a lot of people like that part of the market. Grocery, so food shopping, that's another part of the market that people like because it's proved to be resilient in the face of the lockdown. People have still needed to go out and buy food and shop for everyday needs. Obviously, the flip side of that is shopping centres, which look kind of slightly odd here because deal volume looks very good, but actually in terms of change year on year, but actually deal count I think is a better measure. Deal count is down by almost 80% for shopping centres. The deal volume is up because of some of those larger deals I was referencing in France and Spain. And that's a really part of the market that I think will continue to struggle with the shift to online, which is really accelerated. If you listen to some of the retailers, they've said they've seen many years worth of growth in their online retailing in the last 3 to 4 months. Something that might have taken them 5 to 10 years to grow that online presence has happened in a matter of months. Okay, so looking at the country level, there's a couple of standout stories here. Again, this is second quarter data and looking at the change year over year. Germany looks pretty good of all Europe's largest markets. Although the deal count was down, the volumes were up on the back of some very big deals in the apartment sector, as I've already referenced. And then of the Nordic markets showing there, Denmark is the one that really seemed to see a slew of quite big deals completing. We saw some pretty big deals for offices in Copenhagen, some industrial space, and also residential space as well. And I think that's a major reason why investment in Denmark almost doubled in comparison with Q2 last year. And what I would say though is that the quarterly data tends to be tends to jump around a little bit, especially for the smaller real estate markets like Denmark. It's not a big market in a European context or a global context, and so some big deals can switch those numbers around a little bit. And the other market down the bottom there that I've got on there for interest is Finland, and that's saw a very, very sharp slowdown. And the Finnish market has clearly been buoyed by a lot of overseas money being spent in the last couple of years. And I think, we've certainly seen, and I'll talk about this a little bit later, we've seen the markets that are most dependent on overseas money have struggled the most in terms of the slowdown in investment. That's not just in Finland, we've seen that in Ireland as well, and parts of the Spanish markets in Portugal. So that's a sort of pan-European story. And then just thinking about where's the money being spent so far in Q3. So UK looks okay actually on the back of some quite big office deals, and then some other big industrial transactions as well. And then you've got the markets going down there. So kind of the hierarchy has remained quite similar. And again, just Finland, I've put them down at the bottom. There still has not seen a very significant amount of activity. So there hasn't been a pickup in Q3 in Finland either. So the markets remain very slow comparatively. And then just looking at the sectors of the market, where's the most money being spent so far in Q3? So you've got suburban offices, that's really non-CBD office. So, you could still have an office that's in a central location, but it's not in the core CBD of the market. And we've seen investors move towards those locations in greater number in the last few years, probably in search of a little bit of extra yield in comparison with the core markets, which are very, very expensive. But then you've also got apartments up there. And that's, again, as I've already said, a part of the market that has seemed to be structurally pretty immune from the COVID pandemic, as has logistics, and then which is in fourth place. And then you've got down at the bottom hotels and senior housing, which is a very small part of the market anyway, normally. Okay, so that's our overview of what's happened in Europe so far, and hopefully that set you up to sort of drill down a little bit more into some of the Nordics data. And I thought it would be worth initially, obviously you're all based in the Nordic countries, and I'm based in London, so you're all there on the ground, working in the market day to day. But I thought it would be interesting just to look at some non-property data sources, just to put what I'm going to say in context. And the first one is to look at economic sentiment, which has very clearly taken a hit because of the pandemic. And I know Sweden has obviously treated the viral outbreak quite differently to a lot of European countries. It didn't lock down in the same way that we did in the UK or France or Germany, etc. But despite that, we've still seen a hit in terms of economic sentiment, and we've still seen pretty substantial GDP falls on the back of this in Q2. I think Sweden's economy, I think the GDP fell by about 8%, I think it was. I think some of the other Nordic markets fared slightly better. I've got the UK on there, just an example, and that fared worse. Actually, we saw a double-digit drop in GDP in Q2. But broadly, we have seen a little bit of recovery, but sentiment is still, way below where it was prior to the COVID outbreak and prior to any of us knowing about what was coming. I think what is also interesting, if I also just talk about that, is the hierarchy here. So you are seeing Sweden has also didn't see the same level of drop in sentiment, also seemed to bounce back slightly quicker than the other markets here, and also than the EU as a whole. And I think perhaps that's to do with the different nature of its treatment of the virus, and I'll talk about that a little bit later, that maybe businesses have been more able to keep trading, certainly in parts of the market like the hospitality sector, which was shut down for long periods in other parts of the world. So broadly, that doesn't look a particularly promising picture for real estate investment when you've got low economic sentiment, you've got large declines in GDP. And you've also got restrictions on movement as well, because obviously real estate is a physical asset, and I think that's one of the main restrictions that we've seen in the market, not only linked to the problems in the economy and how that might affect real estate, but also on a more immediate basis, people's ability to move around affects their how they can do deals, because as I said, property is a physical asset, you need to see it. And so this is a data set I've used in a few presentations, and it's from Google, and it's their mobility data. So it's a community mobility reports from Google. And this is tracking people's visits to their workplaces set against the pre-COVID baseline, which was set in January and February. Now, unfortunately, they don't have this data for Sweden, which I think would be the most interesting market maybe to have it, because obviously there wasn't a full-scale lockdown in Sweden. But we can use Denmark as an example here. You saw the effect of the lockdown where people stopped visiting their place of work, and visits to workplaces were down 60% in comparison with pre-COVID, but they actually bounced back very quickly. And obviously we've got the summer holiday period there between July and August, where it seems like the whole of Scandinavia goes on holiday, and so that was almost like a second lockdown in terms of people's visits to their workplaces, but those numbers have bounced back quite quickly from August through to September. And so what does that say to us? Well, it says that the markets look to be in a better state than here in the UK, for example, where we're still 40% down on that pre-COVID baseline. You know, there's still relatively few people taking public transport, relatively few people going into the office, and I think that's feeding into a lack of confidence about the office as a future place of work. And you know, we've just been told today that we should work from home because of the secondary outbreak. Whereas in markets where we've seen a quicker rebound in people's ability to move around, we've seen that feed through into their ability to keep doing deals and confidence in the real estate market. So Germany's done very well on the back of its, you know, swift treatment of the virus, and people have returned to the office in greater number in Germany as well. And it seems like that's the case in other parts of the Nordic markets. And so when we look at investment in the Nordics region in comparison with the rest of Europe, you can see there's a proportion of the market, it's actually jumped up this year, and it's the highest it's been in over 10 years. So Nordic property investment in proportion with the rest of Europe, it's you know, just under 14%. Doesn't sound a lot, but it's averaged at around 10% for the last 10 years, maybe a little bit above that. So that tells us that the markets in this region have been able to kind of keep going in a better way than they have elsewhere, than they have, for example, in Italy or Spain or the UK, where, you know, we've seen very sharp slowdowns. And what are the reasons for that? Well, I think one of them is, you know, maybe there's the domestic focus that you know, Sweden certainly has. Sweden's a very domestic market, and I'll talk about that in a minute or two. Just to kind of drill down into which parts of the market that have seen the most activity. So I've got April through to August, and then the change year over year. So you can see which parts of the market have grown during this COVID time. So, you know, we've got it starting at April there, which is really when we started to see the effects feed through into the real estate market, and going through to August. So just excluding September's numbers because they're obviously incomplete. So what can we say? Well, you've got the Swedish and Danish apartments at the top there. So again, that feeds into what we've seen across Europe, which is that apartments have really been the part of the market that have been most resilient. Elsewhere, we've seen, you know, slowdowns up to 50%. Interesting, quite a substantial slowdown in the Swedish industrial market, which is a little bit of a surprise, given actually appetite for logistics property in Sweden is relatively high from what we can see. But I think, you know, the physical nature of the pandemic and people's inability to travel and just, you know, the general slowdown at schools, I think that's probably had an impact there. And then down the bottom, you've got Danish industrial, which is showing the reverse. Again, it's a small part of the market, and so a few big deals can really buoy those numbers up. But I think the main story there is really the importance of the apartment sector. You know, residential, whether that's, you know, residential for rent or student housing, is really shown to be relatively resilient, and it's a part of the market that I think we'll see more and more capital being allocated to, especially if you think about what's happening in the retail sector, where investors are really shying away from that part of the market. You know, we're in the middle of a big reallocation of capital away from retail towards apartments, especially, you know, the alternative sectors of the market as a whole, but especially apartments. So I thought it'd be interesting just to show a couple of these deals. These are snapshots I've taken actually from the RCA website. Sorry, I possibly should have taken from the Datscha platform, so you'd be more familiar with this, but this is what these deals look like on the RCA website. So this is an investment from Nuveen, who are a UK headquartered institutional investor. They've acquired or they forward funded a development of an apartment building in Copenhagen for quite a substantial amount of money. I think it's just under 100 million euros. So that's an example of overseas money that's been active actually during the COVID crisis. So although, you know, the markets that have been domestically focused have done better, you know, we are still seeing money flowing from one jurisdiction to another. So this is an example of that, forward acquisition there. And then this is a Swedish example here. And again, it's another development deal. So it's a forward acquisition for apartment properties that are going to be completed in 2024. So that's a forward funding there from Heimstaden, who have, forward acquiring those apartment buildings there in Stockholm. And the forward sales or the forward acquisition story is one we've told actually on our insights page, and we've seen as a part of the market, those have held up actually better than the rest. And it seems to be that there seems to be two reasons for this. One is that there's still lots of capital out there, as I said, and there's lots of competition for certain parts of the market. And if you can get in there early, if you can forward fund a developer, or if you can acquire an asset before it's built, then you've got a competitive advantage. And they also tend to be slightly more complex, and I think that weeds out some of the competition as well. So these are parts of, these forward sales are really a part of the market. They've continued to, go quite strongly during the COVID lockdown and during the pandemic, which is perhaps a bit of a surprise, because also, they do demonstrate some optimism about the future, at least in the medium term, because you're acquiring assets that haven't been built yet. Most, these apartment buildings certainly won't have been let or sold yet, or they, certainly not 100% by any means. So it does demonstrate some optimism about the future as well. Okay, so I think what I was going back to my point I was making earlier about one of the reasons why investment in the Nordic markets seems to have held up slightly better is the fact that Sweden and Norway especially are very domestic focused. They've traditionally had a very deep, liquid domestic investor base who've been very active in those markets, and I think that's helped to keep deals going in comparison with some of those markets which are oriented towards the overseas market, which have obviously been affected by restrictions in travel and perhaps some reluctance to kind of keep spending in overseas, perhaps maybe in smaller, less liquid markets. So you can see that on this chart here. This shows the seller-buyer relationships and all the deals that we've recorded across the 4 Nordic markets we're tracking. So you can see the deals that have only involved a domestic player we're up at 60% so far this year, which is a pretty substantial increase over the last couple of years. And actually, if you look at the involvement of domestic players in the market, it's over 90%, and that's crept up slightly as well. And so we can see the differential here actually. So if you're thinking about which of the markets are domestic focused, which are more overseas focused in Europe, we've got a couple of Nordic markets at the top here. So you can see Helsinki, Copenhagen, both of these markets, around 70% overseas money in terms of acquisition volumes in the last 2.5 years. So those are markets that are really dependent on non-domestic capital sources. So in Helsinki, that would obviously be a lot of Swedish money coming in, which maybe the restrictions on that movement are slightly fewer, but also money coming in from the United States, from the United Kingdom, from Germany, from the rest of Europe. Copenhagen, quite similar, quite a lot of other Nordic money, but also some non-European money also being spent there. And then down at the bottom, you've got those markets I was talking about earlier: Stockholm, Oslo, Malmo. Excuse my English pronunciation of the Swedish place names. I'm not going to try doing that today. I need a bit more practice, I'm afraid. But you can see that these are markets that are very, very domestic. So Oslo and Malmo, more than 80% of all acquisitions in the last 2 3/4 years have been from domestic players. Stockholm slightly lower, around 70%, but those are still, the three of the most domestically orientated large markets in Europe, in comparison with Helsinki, with Dublin, Lisbon, Warsaw, which have all seen very, very sharp slowdowns in investment. So if I skip this chart on and you kind of try and keep in mind this hierarchy, which is the more cross-border overseas markets at the top and the more domestic at the bottom, you can see there is a little bit of a correlation here. So the more domestic markets down at the bottom, yes, they've still seen a slowdown, and that's inevitable given the nature of the pandemic, but they've not seen, the 75, 80, 90, 100% level of slowdown that some of these more cross-border markets have seen. We didn't record a single deal in Lisbon in Q2. Interestingly, Copenhagen is the market that's really stood out there. And that's on the back of some of those quite substantial deals I was talking about. You know, there's some apartment deals, quite a large office deal as well in Copenhagen that completed, and that's really buoyed the market. Also, it was quite a slow period 1 year ago, but that's a sort of outlier there. Interestingly, Milan, just out of interest, also an outlier there, but that's on the basis of one very large deal. If you look at the deal count, it would be down around 40 or 50%. So there does seem to be that correlation there between, you know, the cross-border money and the greater slowdown. That's clearly a benefit or a positive for Norway and Sweden, especially in terms of the structure of their markets going forward. If we do see, you know, continued restrictions on overseas capital, these seem to be markets that are better placed to withstand that than some of those other smaller cross-border markets. I thought it'd be interesting just to highlight who is still doing deals across the Nordics. As you can see here, I think I went through these one by one and tried to find a non-Nordic player, and I think the only one I found there was Blackstone down at the bottom, who've obviously they've been very active in the Swedish industrial sector, especially. Not completed many deals, but actually they are the largest provider of capital if you look at how much money they've spent, just over 430 million. But really, the rest of these players are all, you know, largely Nordic players active in their domestic markets. And that's, you know, feeding into the trend I was just talking about, that you know, especially Sweden and Norway. So that's who's still doing the deals. But if you look at as a whole across Europe, and it's true also in the Nordic markets, actually the number of players actively acquiring property has fallen in the face of the pandemic, and that's not surprising. You know, it's become more difficult to do deals. The outlook is more uncertain, and so our numbers, our liquidity score data shows that liquidity has fallen in 3 of the 4 sort of what we call the Nordic A cities. So RCA uses our own investment market data to calculate a liquidity score, and it's based on 6 different indicators, things like investment volumes, number of active buyers in the market, the type of capital that's active in the market, and the amount of cross-border money that a market attracts. And so that's really trying to answer, you know, how liquid is this market versus history and versus its peers. And so you can see, you know, of the 3 of the 4 markets have seen liquidity start to fall away in comparison with the start of the year. So you've got Oslo there, Helsinki and Stockholm both seeing a drop-off in comparison with Copenhagen on the back of some of these quite big deals. Some increased overseas interest has actually seen liquidity increase and has actually overtaken those other 2 sort of markets to be the most liquid market, we think, in the Nordic region at the moment on the basis of these transactions. And I can just make a comparison here with our liquidity scores. If we look at the change year over year in comparison with some of the UK markets and some of the German markets, you can see the slowdown in the smaller Nordic markets, Malmo and Gothenburg, is actually quite large, but actually that's not surprising. They're quite small markets and the scores tend to be a little bit more volatile. And I've got Glasgow on there just as an example to show that that's also the case in the UK. But broadly, the picture is one of decreasing liquidity across global real estate markets, actually not just in Europe, with a few outliers like Copenhagen, Munich, and Cologne there as well. So there are some outliers, but broadly we're seeing a drop-off in liquidity in the face of the pandemic. Now, classically, that would be linked to a change in pricing. So I thought it'd be interesting just to close my Nordic sector with a couple of pricing charts. At the moment, we don't see any sign of office yields moving out. So this is our modeled yield series we produce for markets all around the world, and I've got Stockholm and Oslo on here. And our data for Stockholm actually showed the yields moving in slightly between Q1 and Q2, not by very much, but I think that probably reflects, you know, there is still continued investor appetite for core offices, for secure income streams, or apparently secure income streams, in a low rate environment. And so that seems to be having at least a holding effect on pricing. You know, we haven't seen a significant outwards movement in pricing in in really many European markets just yet. Certainly, or outwards ticking yields. And then, so moving on from the yields to look at our commercial property price indices, which is a slightly different way of measuring pricing in the market. So the yields are based on all our transaction data. We look at what's the average. We look at what the yield of an average property and how that changes over time. Whereas this data set is our CPPI, and it's a repeat sales price index. So it's based on movement of pricing in the market for the same building as it trades over time in the cycle. So if you imagine you've got a deal for a building where the building might have traded 3 times in, let's say, 2011, 2016 and 2020, you can look at the change in pricing from those 3 events. And if you have enough of those examples of buildings trading multiple times through the cycle, you can create a price index off the back of it. And that's what this data is. And broadly, you can see if you look year over year at Q2, most markets, with the exception of central London, are ahead of where they were. Nordic's down at the bottom, the Nordic A cities, which is really dominated by by Stockholm, pricing 5% up. Amsterdam, 10%, prices 10% up versus where they were in Q2 2019. But interestingly, we are starting to see a little bit of movement in the quarterly data. So that's the change between Q2 and Q1. And in Germany, that was flat. Paris, the rate of growth has decelerated very sharply. And the Nordic markets, it seems to have gone slightly negative, but very, very slightly. We're talking plus or minus, or around 0, minus sort of 0.1%, 0.2%. So we're not talking about a very sharp slowdown in pricing yet, but more a leveling off in the rate of growth, and that would be the best way to describe it. And we're consistently monitoring, all our pricing indicators, because I think that's a question we get a lot about what's going to happen with pricing in the market. But the answer at the moment is relatively stable, but there are signs that we are starting to see some shifts. Central London is slightly different, and that's because the market has been badly affected by the Brexit uncertainty, and prices were falling before the COVID outbreak really took hold. Okay, so my last set of slides before I hand back to Julia, just asking the tricky question of where next. Now, clearly, the change in the market has really been precipitated by the pandemic and its knock-on effects on the economy and on our, our everyday lives and our ability to go about, the things that we've normally been doing, and that's why GDP has fallen, so sharply in a lot of Europe, across the world and in the major developed economies. And so I think it's important to keep a handle on what's happening with the viral outbreak, because that obviously feeds into what's going to happen and how, with how governments respond to it, and then what happens in terms of possible lockdowns and how that feeds into, secondary effects on the economy. So, the interesting divide here on the chart is what's happened, the different way that Sweden has kind of approached the outbreak. There wasn't the full-scale lockdown in the way that we saw in most other European countries, but actually what we're not seeing in Sweden is the pickup in cases that we're seeing in the UK, for example, and in other European countries. So this chart is just for, it's from the European Centers of Disease Prevention and Control, and it's the coronavirus cases per 100,000 in the last 14 days. So you've seen that there's been quite a sharp pickup in Denmark, where they did lock down, and in the UK, where we've been announced with new restrictions on pub opening times, and we've been told to work from home, and that's and that's clearly going to have a negative effect, I think, on the economy. The government's been trying to push people towards their offices and trying to push people into hospitality venues to kind of get them spending money again, but actually renewing those restrictions is clearly going to have a negative effect on consumer sentiment, and then on GDP outturn. And Sweden might be better placed to withstand that. And this is just a headline I saw in the Times of London yesterday, actually. I was reading the paper in the morning, and this is a quote that just caught my eye, and I'm sure you've all got your own views on what's happening with regards to how the government in Sweden have treated the outbreak. But there does seem to be some movement or some growth of opinion that perhaps the Sweden is going to manage without a second wave, and in fact is going to avoid a second wave of infections that we've seen in the UK, or we're seeing in the UK. And also, I just thought I'd show this chart here to show France, where the infection rate has really rocketed since the start of August, really, and that's resulting in more lockdowns. You've seen more lockdown restrictions in Spain as well. I think the news from the Netherlands is also kind of more worrying about the viral outbreak there. So this is clearly going to have a negative effect in these markets, in these real estate markets, in the second half of the year. I don't think there's any way you can get around that. If we're subject to more lockdowns in the Netherlands, in France, in the UK, that's clearly going to have an impact on people's ability to do deals, and also their willingness to trade properties and set prices with all the uncertainty that entails. So I think that's a downside for these markets where we're seeing a renewed outbreak of the virus. And I think we're already storing up a little bit of trouble as well through the use of things like the job retention schemes. So this chart is from the OECD, and it shows the percentage of employees in these European countries which have used a job retention scheme. So in the UK, we have the furlough scheme and this comparable schemes throughout Europe to try and keep people in work while the lockdowns are underway. But the trouble is, these schemes are now starting to be withdrawn. The one in the UK is going to be withdrawn in October. There might be some sort of managed replacement of that, but at the moment, I don't think there will be. And and because of the furlough scheme, we saw virtually zero rise in unemployment because people weren't working, but they were still being kept on the company books and they were still being paid part of their salary. And that's the same in a lot of other European countries, the same in Austria, France, Netherlands, Ireland. Comparison with Sweden, and Denmark, the use of these schemes was much lower, and there was a slightly larger uptick in unemployment. But I think what that means is you might not see the sharp increase in unemployment, which I think we're going to see in some of these other economies when the furlough schemes are withdrawn in the autumn. I know Germany's extending theirs, but in the countries where they're not going to be extended, I think we're going to see quite a sharp uptick in unemployment, and that's obviously going to have, again, negative impact on the real estate market. So I think these schemes were good for keeping people in work, but I think the longer they're there, the more it's masking some of the underlying weaknesses. And so I think that's something that's going to come out in the second half of the year. So that's something to bear in mind. And then I've just got the US as the counterpoint on here. In the US was no kind of furlough scheme, no system for keeping people in their jobs, and unemployment has rocketed, very sharply. It has come down from its peak, which was sort of achieved, I think, in May. But you can see there the impact that the pandemic had. It was very swift. So what about real estate investment markets? Bringing it back to our core topic, our pending transaction volumes can be a kind of a good lead for what's going to happen over the rest of the year. So we're expecting, if you look at the volume of pending transactions in our database, those are deals that are in contract but haven't yet completed. At the end of Q2, so at the end of June, they were the lowest level we've seen for quite a long time, and that's the orange, sorry, that's not the orange, that's the light blue bar. And we can sort of project forwards using that to sort of, where do we think investment volumes will be at the end of the year? We think it'll be around, between, I guess, about 100 and 120 billion in the second half of the year. And that's the sort of the margin of error, if we're projecting forward using these pending volumes. So on a par, maybe slightly slower than the first half of the year. So with the resurgent viral outbreak, I don't think we're going to see a very, very sharp uptick investment volumes, despite the amount of capital that's out there that wants to buy real estate. And that's the upside for the market, but I think there's so many uncertainties at the moment. And just the most immediate set of data, what did we see over the summer? So this is daily deals actually going into the RCA database, and then I've got a rolling 10-day total. And this is, again, it's across Europe. So you can see the summer was very slow. If you look at that 10-day total, it has picked up a little bit in September though, which is what we'd expect. People come back to work. We're seeing more questions coming in from our clients across Europe as people kind of return to their desks and start to think about doing deals again. So I think we will see a pickup from that low point that we sort of saw in mid-August. But I think the lockdown, the second wave of the virus, if you want to call it that, will have a dampening effect on that. And then just one more sort of structural question. I've talked a little bit about, the preferences for apartments and industrial. There's a good question about, where can capital go if parts of the market become uninvestable? So, retail is a part of the market that seems to be in a lot of trouble at the moment. And there's certainly not many investors who want to keep expanding their retail portfolios, maybe selectively, but not in a wholesale way. And also there's issues around offices as well. So if you look back in 2007, this is all European investment volumes, 70% of all investment in 2007 was in the office and retail sector, and that has fallen to 50% this year, and that's really been replaced by apartments, industrial, and then those other parts of the market, things like senior housing, and I guess to a lesser extent industrial, but really it's the growth of the apartment sector is really replacing that. But offices are obviously the largest asset class, and there's a lot of questions around what's happened in the office sector. Are we going to keep working from home? I'm working from home today because the UK government has told me I've got to quarantine for a week after I was in Greece on holiday, unfortunately. So I've come back to house arrest for a week, so I'm at home today. But we can still do these presentations, we can still service our clients and continue, more or less close to normal. And so there's a lot of talk about what's going to happen to offices. And we're already seeing companies talking about downsizing, companies cancelling lease contracts. Google cancelled a 200 lease contract in Dublin recently. They're going to take 200,000 square feet, so 20,000 square meters. They cancelled that. We've seen occupancies in the shared office providers fall away. So I think there's an open-ended question there about what's going to happen to offices in the future. I know a lot of people think that the move to home working is really oversold, and we're all going to be back in the office once there's a vaccine. But I think as always, the truth will be somewhere in the middle. But it's certainly something to bear in mind. So finally, before I'll hand back to Julia in just 1 second, just go through these last points very quickly. As a whole, Europe has looked pretty good, and especially if you compare that with the USA, where investment has fallen very sharply. The Nordics have increased their share. Volumes are down, as I've shown, but as a proportion of the European market, it's actually increased. The markets that are most dependent on overseas money have really suffered. Helsinki and the Nordics region, but also places like Lisbon, Dublin, Warsaw. Copenhagen is the one market that's really bucked that trend, although Q3 does look very slow at the moment. And then, as I was saying at the moment about the restrictions on movement, and possibly, as I was saying earlier, that the markets like Norway and Sweden are probably better positioned to cope with these because they're very domestically focused and might not see the disruption that those other cross-border markets will see. Okay, so maybe I'll leave it on the talking points, and I'll hand back to Julia, and maybe I'll show my face again.
Thank you so much, Tom. It is a lot of data,
Yes.
a lot of information to take in. But as I said in the beginning, we will send out the recording and the presentation to all of you afterwards, so you can go through it again. And Tom, we will answer some questions now, but if there are more questions, is it okay to reach out to you or your team?
Yes, yeah, of course. I don't think my email's on the presentation, but I'm sure we can sort it out.
Your details in the email that we'll send out. And it's really interesting where you talk about the offices and the concerns about that, but then you also talk about the yields that they are just like moving out, like it's not really anything happening to them. But does RCA or your team have any prognosis like on the pricing on offices as of now and the total volumes in the end of the year?
So the pricing story is an interesting one, because the deals that are being done have tended to be for the kind of the prime assets, I guess you'd say, the good quality space. And so those have been at yields that are very similar to the ones that were being set pre-COVID. So we haven't seen a big outwards adjustment in yields just yet for the properties that are trading, but the properties that are trading are selective because volumes are down. So it's the better quality assets where investors are most confident about continuing to acquire those that are actually trading, and they're not moving up the risk spectrum in the way they might have been this time last year. So we're not seeing necessarily the secondary offices trade. We're not necessarily seeing the those offices with lots of vacancy trade because of potential concerns about about filling that space. When companies seem to be talking about releasing space onto the market. And I think the other thing to say is, so you've got that factor, and then you've got the factor that the return, the income return that you can generate from real estate still looks very attractive in comparison with the returns you get from other asset classes, especially from fixed income. And if you look at the difference between financing costs and real estate yields, it still looks very positive. So there's a decent cushion there for prime property, and I think that's why we're not seeing yields shift yet. In terms of volumes, I mean, that's a difficult question because you can have some very big deals which will push things up and down. But if I come back to what I said at the end of the presentation, our pending deals across Europe look pretty slow at the end of Q2, so that would suggest a sort of fairly muted second half of the year, especially in light with what we're seeing about the resurgence of the virus in some countries.
We also got a question if it shows in your data set, so maybe you just have the overall price, but do you see anything on the rent levels for offices and retail specifically? If they're going...
Yes, that's a good question. I mean, we don't actually track rental pricing, and so the RCA data is focused solely on the capital market side of things. So we're tracking what buildings are trading for. You can kind of back out rental growth or rental levels on that, but we haven't done that yet. I think the early indications are that with vacancy rates starting to rise, I think we will see a softening in rents in certain markets. We saw very low take up in central London, for example, in Q2, as I think July was the lowest ever level of take up. And I think if those conditions persist and we start to see increase in what we call grey space, so that's space coming to the market being sublet by tenants. So it's not necessarily new space. It's tenants trying to sublet space, or tenants moving out of space and it being released onto the market. I think that's going to cause rents starting to fall away in the office sector. For retail, yes, I mean, rents have been falling for a long time, especially in the secondary locations, and I think that's going to continue.
Yeah.
So, there's no doubt about
that. So what is your prognosis on the whole year of the investment volumes in the Nordics? How much because now we had the pandemic was going down, but now it has risen a bit in a lot of markets. Will that have would you have another view like a week ago, 2 weeks ago?
Yeah. I think it really does differ from market to market. So Denmark and Finland are the two Nordic markets which are home to a lot of overseas money. And I know a lot of that is money moving within the Nordic region, but I think that that presents more of a downside risk to those markets. Finland looks very, very slow, and I think it will probably continue to be. I think Sweden is probably better placed. Certainly the economic forecast I've seen for Sweden look relatively positive for the second half of the year, and the domestic focus there, coupled with the slightly more positive picture on the containment of the viral outbreak, would mean that Sweden should have a better second half of the year than I think some other European markets. But obviously, it's also, and again, I saw Swedish 10-year bond yields have gone negative again, and so that again provides a positive backdrop for real estate investing. So I think a more positive picture of those domestic markets and slightly more negative for the ones that are focused on overseas money.
Thank you so much, Tom. We'll see if we have any more questions coming through. We have another 5 minutes, so people, please, if you have questions, just write them in your menu bar. We also got a question asking about outside of the Nordics, with focus on the US. So do you see the money flow from US increasing? And then I guess it is money flow into the Nordic.
Yeah, that's a good. It's a really good question. I've been thinking a bit about what's happening in the US at the moment because, as a kind of a backdrop for a real estate investor, you know, the US politics is so febrile at the moment, and you know, you've got obviously got the elections coming up. You've got, you know, a lot of domestic, you know, kind of turmoil and protests, and so I wonder whether that might have an impact on domestic spending by US, you know, institutional investors, and whether that might push them to start spending a little bit more overseas. So I think that's probably an open-ended question rather than that's not an answer, but I think that's something that maybe, you know, something to think about in the next few months. In terms of the actual numbers, you know, US investment into Europe was down in Q2 in the same way that, you know, money being invested, you know, cross-border money all around the world was down, and that's really just the nature of the pandemic and the restrictions that it's putting on property deals. And then the interesting divide is between those players that have local presences, you know, a local presence, and those that don't. And so I think, you know, the very large US investors who have a presence on the ground, you know, in the Nordics, in other parts of Europe, they're going to be more able to do deals, and they're clearly, you know, they're still very, very well capitalized. So they've still got huge amounts of equity. You know, Blackstone have closed another enormous fund relatively recently, and so they do have money to spend. And I think the issues are where they can deploy it, how they can deploy it, and their targeted sectors. Because if you look at where Blackstone are active, it's really in three parts of the market. It's, you know, industrial, well, logistics, apartment, and offices. And you know, they're going to keep active in those parts of the market, but you know, partly that's, you know, driven by opportunities as well. And so I think that's that. Sorry, just my last point was that would be that last point I was making about, you know, is the investable universe shrinking a little bit because of the structural changes that are taking place?
Yeah. I think we have time for one last question. We will not overrun the time, but we also got a question about Brexit. Have you done any like progress of like how that have affected and will affect and like on the Nordic CRE market?
Gosh, I mean, the impact on the Nordic, I think, would be pretty minimal. Really, I think, you know, you guys are pretty well removed from the mess that we're in over here. Maybe gladly so. I mean, in terms of, I mean, there's definitely been an impact on the UK market. You know, volumes are down from where they were in 2015, which is just prior to the vote. You know, London has fallen from being the most liquid in the market to like number 16 or 17 on our rankings, and so that shows the impact on the UK. On the Nordics, I can't really think it'll have a huge amount of impact. I mean, there is some UK money, that institutional money that has historically been active in the Nordic markets. You know, we saw Nuveen. I showed that on the chart earlier, but I'm not sure that it's going to have a substantial impact on their ability to do deals, provided there's provided the necessary agreements are in place. I think the likely impact is here at home rather than abroad.
Yeah, maybe money that would go into the UK would go into Nordics instead.
Yeah, possibly, yes. I mean, there might be some of those flows might be, you know, pushed towards those markets. You know, I think there's traditionally just been, you know, cross-border investors have just had difficulty acquiring assets, especially in places like in Sweden and Norway, because the market is so domestically focused, and you know, the assets tend to be traded within those kind of domestic investor base. But yes, they might be a recipient of some diverted capital. Yeah.
Yeah. Thank you so much, Tom, for joining us for this webinar, and we'll see if we make another one after the pandemic, whenever that is.
Yeah.
Thank you all for attending, and we will send out the presentation as said. Have a good day.
No problem. Yes, thank you very much, everyone, and have a good day.